Hey, hi everyone, this is Mayank Kothari. Today we are going to start with the new chapter, that's portfolio management, fifth chapter. This is going to be an amazing chapter. Few things that I want to tell you about this chapter is that this chapter has lots of formulas and we will have to continuously revise in every lecture so that we remember all those formulas. Okay, one thing. Second thing is that this chapter has 95 questions that we have to solve. So the questions in the beginning are very easy, but the moment we will move on to the end of the chapter, we will see lots of difficult questions, and that's the place where you should focus more. If you can solve those questions, the end of the chapter questions, then I think you will be able to solve this entire portfolio management very easily in exam. Okay, this chapter holds a good weightage in exam, so please make sure that you are not skipping it. Skipping any chapter is already not an option. Even if you skip one chapter, that means you are not eligible to sit an exam or clear the exam. So please remember that thing. You can't complain later on about the exams if you are skipping anything. So yeah, portfolio management chapter is the last chapter for section 2. There are almost 6 sections, and the second, third and fourth is going to be the biggest sections. So second section's last chapter is portfolio management. Now coming over to some concepts and all that thing. So you will start with return and standard deviation. The good part about the initial questions are we have already discussed about these concepts before we started the risk management chapter. So now we don't have to again spend 2 hours revising everything. If revising or discussing everything, we will just go through the revision of those concepts and then we'll start with the first question immediately. We will have a detailed discussion when I think we will be looking for the formulas of, let me just tell you, when we will be looking for the formulas of covariance and correlation. Otherwise, return, risk, portfolio, weighted average, all these concepts have been covered by us in that chapter. Basics before risk management. That was the chapter. That was the lecture. Okay. So this way we are going to complete all the 95 questions. Then let's come over to the chart. Okay. So before starting a single thing about the portfolio management chapter, we are going to spend around like 10-15 minutes at least revising what we have done till now. So let's start with the charts. If you remember, we started with the risk management chapter. This is all theory you have to cover, and these were the formulas. Okay, let me just go through the formula book. I think that will be very convenient for us. Please make sure that for the theory, charts are also important, so you will be very happy to revise every one chart every day at least. Okay, so we started with the basics, time value of money. By now I think you have understood the importance of this basics time value of money, because we have used these formulas, effective rate, perpetuity, annuity and compound amount lots of time in the security valuation chapter. Okay, basics, time value of money. The very first formula was simple interest is equal to principal into time. Have a look. Simple interest is equal to principal into rate into time. Okay, then compound amount is equal to principal in bracket 1 plus r, rate of interest per annum, divided by number of compounding in a year to the power nt. Then effective rate of interest, if you remember, 1 plus rate of interest per annum divided by number of compounding in a year to the power n minus 1. We are not taking t here because there is no need to. Present value and future value is a concept derived from the compound amount and the present value formula itself. So this formula is nothing new but the compound amount and principal formula. So future value is equal to present value into future value factor, which is nothing but 1 plus r divided by n to the power nt. Then if you can calculate the present value on this side, then future value divided by 1 plus r to the power n to the divided by n to the power nt. Then this entire 1 divided by 1 plus r divided by n to the power nt is called as present value factor. So present value is equal to future value into present value factor. That was the case. Now we also learned about the present value of annuity concept, where we can calculate the present value of all the similar cash flows. So if for 5 years the cash flow is same, we can take it once and then take the total of the present value. So we will call it as present value annuity factor. Then present value annuity factor into annuity becomes the present value of annuity. Last topic was the perpetuity, in that where we can calculate the present value of future cash flows if that particular cash flow is occurring for infinite number of years. So we can take that periodic cash flow in the numerator, then divide it by rate of interest, and then value of the perpetuity. So if you want to calculate value of shares, this R will be cost of equity. If you want to calculate value of preference shares, this will be cost of preference shares. If you want to calculate value of bonds, this will be YTM. And accordingly, equity dividend, preference dividend or interest will be kept in the numerator. So basically, it depends upon the type of the instrument. If you take equity share, the numerator will be equity dividend, preference share, preference dividend, bond, interest. Then we discussed about lots of ratios in that. So I'm just going to take you through this also. Debt equity ratio is nothing but the total debt in the company divided by shareholders equity. So debt, outsiders money, shareholders equity, owners money. Debt to capital ratio is nothing but total debt divided by the debt plus shareholders equity. So understand the difference between debt equity ratio and debt to capital ratio. This capital includes the debt as well, right? So if I say that 2 rupees is the debt and 3 rupees is the equity, in this formula it will look like this, 2 by 5, because the total capital will be there in the denominator. Then we also discussed about the fixed interest coverage ratio, where we can take EBIT divided by interest payment plus preference dividend. We can also calculate it after tax. In that case, we will add interest in the after tax profit if you want to calculate this ratio after tax. Okay, return on capital employed. Capital employed includes debt, equity, preference, everything. So we will take the return of all those debt, equity, preference in the numerator. That is called as EBIT. EBIT is something, understand, remember this free cash flow formula. EBIT is something from where debts, interest, equities, preference shares, dividend and loans interest are paid. So in the numerator, you take the return for those people whose capital is taken in the denominator. Understand, I am repeating. In the numerator, you are going to take the return of those people for which you are taking the capital employed in the denominator. Obviously, you are going to deduct the tax out of it, because tax pertains to government, and government doesn't put any money in your company, so that capital is not included. Okay, return on equity specifically means the equity only. So in the numerator, you will take the return of the equity, which is dividend, and in the denominator, you will take the total equity capital. So profit after tax minus preference dividend is the profit which pertains to the equity shareholder that we have earned, and in the denominator, equity capital. We'll discuss about this cost of goods sold. I think it was there in the CA Inter costing subject. Cost of goods sold means nothing but, if you understand, if you imagine the trading account, purchases plus opening stock are on the debit side minus closing stock on the credit side. Net of all these three becomes the cost of goods sold. Okay, so effective tax rate is nothing but the income tax expense divided by profit before tax. Profit before tax is the profit out of which this income tax expense is incurred. So if we want to calculate the rate, it will be simply the tax expense divided by the profit before tax. We'll discuss about the weighted average cost of capital in the corporate valuation chapter, but this has already been done in the CA intermediate financial management chapter as well. There was a chapter called as cost of capital. In that, you learn about this formula, and this is very simple. If you want to calculate cost of equity, it is KE. If you want to calculate cost of debt, it is KD 1 minus T, because KD normally is before tax, so we convert it into after tax. KE is already after tax. And if you want to calculate cost of mix of both the capitals, then it will be the weights multiplied by cost. Dividend rate, dividend yield, and dividend payout ratio. Rate is applied on the face value, yield is applied on the market price, payout ratio is applied on the earning per share, that we learned. Okay, price earning ratio is also easy topic. It says that how many times the market price is trading in the market as compared to the earnings. So okay, if the company is earning 1 rupee and the market price is 50 rupees, then we can say that the 50 is the price earning ratio. So this 50 explains how many times of earnings the market price is trading in the market. 100 basis point is equal to 1%, 200 basis point into 2 is equal to 2%, 75 basis point is equal to 0.75%. Okay, good. Then we started with the risk management chapter, and we started with this formula first. This was the basis for every other chapter, every other formula. Now understand, we calculated, we discussed how to calculate the z value, z score, which is nothing but the observation that we need minus population mean. That means from the mean how much distance is there, okay, divided by standard deviation. So x minus mu divided by standard deviation was the formula. We had derived this formula with a proper logic in the risk management chapter, if you remember. If you remember that question where the profit average mean was 2 crore, standard deviation was 1.6 crore, and we had to find out that what is the probability that company will be in financial difficulty if it crosses 1 crore rupees of the loss. So we first in the numerator found that how much we will have to travel from 2 crore rupees of the profit to 1 crore rupees of the loss. So that was 3 crore rupees of the loss. 3 crore we will have to come down by the profit and divided by 1.6. So we arrived at a figure of z score, and that z score has to be located in the z table in order to know the probability, and that probability was 3.04%. That means this much are the chances that you will be in financial difficulty, but 96.06% are the chances that you will not be in financial difficulty. Okay, so we started with that thing. Then we started with this next formula, that is value at risk. Please understand that this formula is also derived from the same formula. This x in the z score is nothing but the value at risk, and when we calculate value at risk we take mu as 0. So ultimately the formula remains as z is equal to x divided by standard deviation. So var is equal to standard deviation into z score, right? So this is the same thing. var is equal to z score into standard deviation. If you want to calculate var for multiple days, then it will be z score into standard deviation of 1 day into under root t. Understand, standard deviation of 10 days is nothing but standard deviation of 1 day into under root t. Okay, this z score into standard deviation of 1 day can also be called as var of 1 day. So var of 1 day into under root t will also give you var of 10 days. Standard deviation of 10 days is equal to standard deviation of 1 day into standard deviation under root 10. If it is in months, standard deviation has to be of 1 month into number of month. Okay, portfolio variance, we understood that, we also discussed that when we calculate the portfolio variance in currency, then we don't have to take any kind of a weight here. So it is nothing but standard deviation of a square plus standard deviation of b square plus 2 into standard deviation of a, standard deviation of b, correlation coefficient of ab. Portfolio var is calculated on the same basis, var of a square plus var of b square plus 2 into var of a, var of b, correlation coefficient of ab. But all the formula, whether it is variance or whether it is portfolio var, it is calculated in square format. You will have to do the square root of this in order to arrive at the standard deviation. Okay, then to standardize a normal variable, okay, that was completed. Then we came to the security analysis. If you remember, absolute breadth index is nothing but number of advancing stock minus number of declining stock divided by the total issues traded. So if we are trading 50 stocks, out of that 30 are advancing minus 50s are declining and 5 stocks are unchanged. Okay, confidence index is related to the bonds average grade, best grade bonds average yield divided by intermediate grade bonds average yield. RSI is nothing but relative strength index, which shows that how much your stock is strong. So percentage change in the stock price divided by percentage change in the index shows you the strength of the stock. Okay, Arithmetic simple, strength of the stock as compared to the average economy. So this percentage change in the index represents the economy. Arithmetic simple moving average, it is nothing but the total of the closing prices divided by the number of observation. We can easily calculate the arithmetic meaning moving average. But the main problem I told you with the arithmetic moving average is that it gives equal weight to the data or to the prices, old prices as well as compared to the new prices. So equal weightage to all the prices is not something which will continue in the future. Current prices has to be given lots of weight. So equal weight to all the prices is the major reason we came up with exponential moving average. Exponential moving average or weighted moving average gives more importance or more weightage to the current prices rather than the old prices. So the formula for that was very simple: current price into exponent plus previous EMA into 1 minus exponent. So if exponent is 20%, 1 minus exponent will be 80%. This exponent can be calculated very easily if not given in the question. 2 divided by n plus 1. Run test analysis, if you remember run test analysis, we had these 7 steps. First 3 steps are nothing but calculating the total number of runs where the price is changing. Total number of positive price changes, total number of negative price changes. Then we used these 3 things to calculate mean and standard deviation with this formula, and with the mean and standard deviation we calculated lower limit and upper limit. If your number of run, that is first step, comes in between 6th and 7th step, that means market prices, the current market prices are independent of the past prices. That means current prices does not depend on the past prices, it is randomly decided. But if it goes, this number of run goes beyond these steps, or we can say if it does not come in between 6 and 7, then we will say that the current prices are dependent of the old prices, and that is very bad for the market. No one is going to trade then. Okay, then we discussed about the security valuation chapter. This is going to take some time, please understand. Security valuation means valuation of the securities like equity share, preference share, bond valuation, etc. In that thing we used to calculate the theoretical market price, compare it with the actual market price, and then we used to decide if the actual market price is greater than theoretical market price. We used to say that it is selling at a higher price in the market, it is overvalued, it's better to sell rather than purchasing. So actual market price, if it is equal to theoretical market price, that means whatever we were thinking the price should be, it was there and the shares are correctly valued, we should hold on to the shares. If the actual market price is less than theoretical market price, it means that the price that we were thinking it should be there in the market, the actual market price is very less than that, it is lesser than that, and that's why the shares are selling cheap at lower cost and at undervalue, and it is undervalued, so we should buy the shares. Okay, so calculating theoretical market price depends upon a particular theory. We saw this first theory as a Walter's model. Walter decides that okay, this formula entirely depends upon the perpetuity formula. Market price is equal to earning per share in the numerator divided by cost of equity. This earning per share is then divided into dividend and retention earning. That retention earning, E minus D, is then multiplied with ROI divided by cost of equity to represent the extra earnings contributed by the company. Okay, then if ROE, optimum dividend payout ratio, understood, ROE is greater than cost of equity, that means company's return is higher than investors' expectation. Investor would want company should retain all the earnings with them and should not distribute any kind of a dividend. So optimum dividend payout ratio will be 0% at that time, and at that optimum dividend payout ratio, market price will be higher. If ROE is less than cost of equity, that means company is not earning well as compared to the investor would want company to distribute all the dividends, so 100% will be the optimum dividend payout ratio, and at that time the market price will be highest. If ROE is equal to KE, that means company is earning exactly equal to the investor. So if it doesn't matter if the company is distributing any kind of a dividend or not, the market price will not change in that case. Okay, then we came up with this formula of dividend based model. This is the formula that has been there in the CA intermediate. If you remember, return on equity is nothing but according to DuPont analysis, net profit margin into asset turnover ratio into equity multiplier. Have a look. Net profit margin is profit after tax divided by sales. Asset turnover ratio is sales divided by assets, and equity multiplier is assets divided by net worth. This is what you have to remember. Now profit after tax divided by sales, so this sales in the denominator and this sales in the numerator will get cancelled. Whatever will be the remaining part will be profit after tax divided by assets, and this asset will also again get cancelled and divided by net worth, that is shareholders share capital plus reserves and surplus. So if you have this kind of a data, you can calculate ROE. Otherwise profit after tax, otherwise the net formula is nothing but profit after tax divided by net worth. Okay, dividend based model. Then we saw the Gordon's growth model. So if there is no growth, market price is nothing but dividend divided by cost of equity. Ensure that this dividend should be D1 if you want to calculate P0. The cash flows in the numerator are always a year ahead. Okay. Then single period holding. If we are holding for a share for just one period and not perpetuity, this is perpetual, right? But if we are holding it for one period, that means the market price today is nothing but the dividends present value and the market price at which we will be selling at the end of the year 1. So it is nothing but D1 present value, P1 the selling price, present value. Okay, constant perpetual Gordon's growth model. This is like including the growth in here. It is nothing but D1 divided by market price. Okay, understand. Cost of equity is equal to shareholders' expectation of returns from the company. Now, what kind of returns are being expected by shareholder from the company? First return is the dividend yield, that the company should pay dividend, and the second return is the capital appreciation, that the investment that I have made should grow in capital over a period. So dividend yield is calculated as D dividend divided by market price. Yield is always calculated on the market price. So D1 divided by market price will be dividend yield, and capital appreciation will be the growth of your investment. So cost of equity becomes D1 divided by market price plus growth. If you transfer the market price on that side, the formula will look like this. Market price is equal to D1 divided by cost of equity minus growth. D1 divided by cost of equity minus growth. This D1 can again be converted into D0 in bracket 1 plus G divided by cost of equity minus growth. You should remember this formula. This has been used in lots of questions, and this will again be used in the portfolio management chapter. Okay. Okay, in case of declining model, in case of declining growth, what you can do is, instead of adding the growth in the numerator and deducting the growth in the denominator, what you can do is deduct the growth in the numerator and add it in the denominator. Why? I will tell you. This is a declining growth model. The growth is not increasing, it is declining model. It's not a growth model, we can say it's a declining model where dividend every year is coming down. First you paid 5 years, then you paid first you paid 5 rupees, then you paid 4.5 rupees, then you paid 4 rupees, then you paid 3.5 rupees. So the dividend amount is declining over a period. In that case, you can use this formula. Okay, 1 minus G in the numerator instead of plus, and 1 cost of equity plus G in the denominator instead of minus. So two-stage dividend discount model is very simple. Calculate the present value of the dividend of the first stage and then perpetuity. This is market price of N. 3 stage will also be same. Now H model, if you remember H model, we incorporated H model, and in that cost of equity minus, there were 2 different growth rates. Okay, first of all, the most recent dividend payment is D0. GC means the initial or current high growth rate. GN means the terminal growth rate. R is the rate of discount, and H is the half life of the transition period, or we can say, instead of transition period, high growth period. Write down high growth period. Okay, so D0 in bracket 1 plus GN. N is the terminal growth rate divided by cost of equity minus GN, plus D0 again into half life of the growth period, high growth period, in bracket GC means the initial high growth rate minus the terminal growth rate divided by cost of equity minus GN. On both the side, in the denominator, the growth which has been taken is the terminal growth rate. The formula is same, KE minus GN, KE minus GN. Earning based model, in case you are using earning based model, then instead of dividend in the numerator, what you can do is you can take the earning per share. So if you take earning per share 1 minus b is nothing but retention ratio, and 1 minus b is nothing but dividend payout ratio. When you multiply earning per share with the dividend payout ratio, it gives you d1. So ultimately we are coming to the same formula. BR, understand, BR, retention ratio into return on investment, is nothing but the growth, right? PE multiplier, that is price earning ratio, is nothing but market price is equal to EPS into PE ratio. If your 5 rupees is the earning per share and the PE ratio is 10, then the market price has to be 50. Good. What is EPS for this market price? Equity share, profit after tax minus preference dividend. This is what you should understand. Profit after tax minus preference dividend. Okay, let's move ahead to the next question. Then we saw the formula of enterprise value. Why we discussed about the enterprise value? Because the market value of equity doesn't give us the true cost that we are paying to buy the company. After paying the equity cost, we also pay to the preferred equity and value of the debt also. So these are also these also becomes the liability to us, which will result into the cash outflow. So basically the value of the company should be equities market value, preference shares market value, and debts market value plus minority. Whatever the liability that you have, add them and deduct the cash and cash equivalent, because you are already taking this amount back the moment you are buying the company. So the enterprise value will get reduced by this much of the amount. Okay. Then we saw the enterprise value to EBITDA multiple. Enterprise value divided by EBITDA. So if the enterprise value is 500 and the EBITDA is 50, that means 10. What do you mean by 10? In order to earn 1 rupee of the EBITDA in this company, you will have to pay 10 rupees as an enterprise value. But there are some companies who are called as startups, and in the startups there is no EBITDA in the initial year. EBITDA is in losses. Basically there are no profits in the initial year. It is losses in the initial year, and that's why this particular multiple is not applicable to the startups. For the startups, the sales is more important in the beginning. So enterprise value divided by sales means for every 1 rupee of the sales, the value of the company is 5 rupees. Free cash flow to firm and free cash flow to equity. Please understand, firm means you are calculating the cash flows from the angle of all the capital investors, like we can say equity, preference, debt, and loan holders. When you calculate from these people's angle, we have to take all the earnings of these people after taxes. So you will start from EBIT minus taxes. That is the better version. But there are lots of formula for calculating FCFA. It depends upon from where you are starting. If you start from this EBIT, this is the base. This is something which you can rely upon. EBIT 1 minus tax. EBIT 1 minus tax means you are paying off to the government. Then you are adding back the depreciation because you had deducted the depreciation, which was non-cash item. Okay. Tax has been paid, non-cash item has also been adjusted. So then you will adjust the balance sheet. That is capital expenditure plus minus change in non-cash working capital plus short-term debt issued, because this short-term debt issued or repaid is not covered in the firms. Okay. Then these are the rest of the formulas. If you start from EAT, the first thing that you will do is bring this EAT to this point. And for that purpose, this is going to be the formula. EAT plus 1 minus interest into 1 minus tax. Okay. Then we discussed about the free cash flows to firm. I will directly shift to this. Free cash flows to equity. Now free cash flow to equity means you will start from the earnings of the equity. So you started from EAT plus you added depreciation because it was non-cash item, plus minus capital expenditure, balance sheet item, plus minus change in working capital, non-cash working capital, balance sheet item, plus any new debt if you have issued, minus any debt repayment if you have repaid. Okay. Yeah, we discussed about this one also. 1 stage, 2 stage, 3 stage dividend discount model. Then we came up with this formula with the new concept, that is right shares. X right price of the share was very simple. The current number of shares into the current price will give you the current market value of the company plus additional shares N1 being issued by the company for subscription price S. So this will give you the total funds that the company is issuing now, divided by the total number of shares after the right issue, N plus N1. Okay. Then we discussed how to calculate the value of the right. Most of the time we were calculating value of rights on. Whenever it is not discussed in the question, you have to assume that it is writes on. Okay, so value of right can be calculated using any of the three formula. The answer will be correct all the time. N1 in P0, understand? N1 is the number of new share, in bracket P0 is the current market price, minus S is the subscription price, divided by N plus N1 is the total number of shares. P0 minus P1. P0 is the current market price, P1 is the price that has been calculated from this formula, right? So the old market price and the new market price, the difference between both of them will be value of the right per share. This is value of the right per share. Now value of the right per share again can be calculated with this formula, but the main thing is instead of P0 you will take P1 in the numerator. So P1 minus S divided by, multiplied by N1. In that case you should not take N1 in the denominator, N plus N1 in the denominator. Okay. Then comes the value of right. Value of right is nothing but P0 minus value of right X right is nothing but P0 the current market price minus the subscription price divided by S. Divided by N means the number of existing shares. Okay, let's move on. Value of the preference share is based on the same concepts of value of equity share on the perpetuity. If the preference share is redeemable, that means it is going to end somewhere. Calculate present value of all the future cash flows, which is preference dividend. If it is irredeemable, the value of the perpetuity formula will apply. In that case, you will take preference dividend in the numerator and cost of preference in the denominator. Then we started with the bond valuation. Again the same thing. Bond valuation is nothing but present value of the future cash flows, where future cash flows include I for interest and RV for redemption value. So interest was an annuity figure, so we can multiply this annuity with the annuity factor, and then we multiplied the redemption value, which was one-time figure, one-time cash flow, with the last year's present value factor. Okay. With this formula, we can calculate bond value, theoretical value, we can say fair value, also intrinsic value. All these are the names of this. We can also calculate YTM with IRR method, if you remember. Okay, let's discuss about, one more thing. If the semi-annual interest rates are given and the coupon payments are semi-annual, then interest will also become half, YTM will also become half, and the number of period will be double. Okay, current yield is nothing but it is based on this formula of perpetuity. Understand, this is P, this is annual cash flow, and this is R. If you transfer this P and this R2 on this side, so P is equal to cash flow by R. Current yield is nothing but yield is equal to interest by market price. Now let's discuss about YTM. Yield to maturity can be calculated with two formulas, average method and discounted cash flow method, that is IRR method that we discussed. Mostly this is more appropriate if you can do so. Otherwise average method can also be used. Average method simplifies the things and it calculates the average of the return. There are two returns when you invest in the bond. First is the coupon payment, that is interest, and the second is the capital appreciation. But obviously the capital appreciation calculated as the redemption value minus the market price value, the amount that you are getting at the end and the amount that you had invested. So the difference between two will be the capital appreciation, but it is divided all over the bond's life. So that's why we will calculate the capital appreciation per year. Coupon is also per year. Now the capital appreciation is also per year divided by the average investment. So the answer will also be per year. If you take half year coupons rate, half year's capital appreciation, the answer will also be half years. Okay. Then yield to call or yield to put, callable YTC. So the only thing that will change in the formula is the instead of redemption value, you will just place call value. Okay, and the number of periods still call. Rest all is same. Duration of the bond had four different formulas, of which we were using three formulas. First formula was summation of weight into year. Second formula was summation of present value into year divided by summation of present value. Third formula was 1 plus YTM divided by YTM minus. Please understand the sign here. Lots of people get confused. Lots of students get confused about this sign. This is a minus sign, then 1 plus YTM. 1 plus YTM plus time in bracket coupon minus YTM divided by coupon outside the bracket 1 plus YTM to the power T minus 1 plus YTM. Okay, that was just a revision. Then we reached at this formula. Modified duration is nothing but the amount, the percentage change. It shows that the percentage change in the market price for every 1% change in YTM. So the formula will be Macaulay's duration divided by 1 plus YTM to the divided by n. So we will talk about this later on when we will reach to that question. YTM divided by n means the number of compounding in a year. If there are multiple compounding in a year, the YTM has to be taken as divided by n. Then we discussed about the two formulas of convexity. If you remember why the convexity was derived, because modified duration had one problem. And what was that problem? The problem was that if you increase the change in the YTM to 5%, the change in the market price will not give you the accurate figure, or it will give you the erroneous figure. Okay, and that's why we introduced the convexity, where we said that this modified duration should be adjusted. So this modified duration was being adjusted by this formula. So this is the modified duration. This is the change in the market price according to modified duration, which we are calling it as erroneous. And that's why we are doing some adjustment in that so that we can get closer to the real figure. And I'm saying that closer, not accurate. So that's why we are using approximate sign here. Change in the present value is nothing but minus annual modified duration. Minus is because YTM and market price changes in opposite direction, into change in yield, let's say 1%, 2%, plus convexity into change in yield square in decimal. So if there is 2%, 0.02 square. If there is 0.75% of the change, then 0.0075 will be the will be written like this here. Okay, and then convexity. For convexity, we need three different market prices: the market price at current YTM, the market prices when the YTM increases, and the market prices when the YTM decreases. So PV plus PV minus 2 into PV0 divided by 2 into PV0 into change in yield square. After that, we discussed about the bond immunization. If you remember, investors' horizon should be equal to duration of the portfolio. Why? Because if we want, we should not suffer any losses, then duration is the point where the change in the YTM does not affect the cash flow. So the duration of the portfolio has to be according to our investor, our horizon. So if we need money in 5 years, the duration has to be 5 years. You will have to keep adjusting that. Please understand that present value of the asset should be equal to present value of the liabilities, and also duration of the portfolio is nothing but the weighted average. So you will just do it like this with W1 D1 plus W2 D2 plus so on. Then we saw the last topic in the convertible bond. We had 10 different concepts in the convertible bond. The first one was conversion ratio, which shows that how many number of shares you will get at the time of converting one bond. When this conversion ratio was multiplied with the market price of the equity share, you found conversion value. This is the value which will become your portfolio value when you convert from market price of the bond to conversion value. So if the market price of the bond is 900 rupees, then conversion value has to be higher than 900 rupees so that you will exercise your option. Otherwise you will not exercise your option. Then comes the conversion premium. Conversion premium is very simple. If the conversion value is 700 rupees, market price of the bond is 900 rupees, then we can say that instead of buying the equity share, if we are buying the bond, then 100 rupees extra amount that we are paying. So we can calculate this 100 divided by 100 divided by 700. 200. 900 minus 700 is 200, the premium that we are paying. So 200 divided by 700 will be the ratio. So conversion premium ratio is the market value of the bond divided by conversion value minus 1. Straight value of the bond is the value of the bond calculated in a similar manner, that is our redemption value into present value factor plus interest into present value annuity factor. This is a bond with the same features as the convertible bond, except one feature, which it cannot be converted into equity share. So the conversion option is not there in this bond, otherwise everything is same. That will be called as straight value of the bond. Minimum value of the convertible bond, I told you that the convertible bond, if starts falling, it cannot go beyond conversion value and beyond straight value, so it should be higher of the two. Okay, then we found the downside risk. Downside risk means the difference between the market value of the bond with a conversion option and a bond value without a conversion option. Bond value with the conversion option, bond value without a conversion option. The difference between these two is called as the downside risk, and we can calculate the ratio of that: market price of the convertible bond divided by straight value of the bond minus 1. Then came the conversion parity price at which the investor will neither gain nor lose on buying the bond and exercising it. So have a look. Conversion parity price, market conversion price, we can call it as a break even price, or we can say minimum price of equity share at which there will be no loss or profit. So these are the different words that has been used in the questions. Now, favorable income differential per share. If you are not buying equity share, that means you are losing 30 rupees of the equity dividend. But instead, if you are buying the bond, then that means you are earning 85 rupees as on interest. So favorable income differential is the interest on the bond minus equity dividend, that is 55 rupees, if you remember that question. Okay, but for that extra 55 rupees of the income, we were paying premium. So if we would have if we would have purchased equity share, it would have costed us 700 rupees, but now we are purchasing 900 rupees bond. That means we are paying a premium of 200 rupees. Why? For that extra income of 55 rupees every year. So this 200 rupees of the extra amount paid for this income is recovered in how many years? That is called as premium payback period. So 200 divided by 55 will be give you the premium payback period. Now, then understand some points. Dirty price and clean price. Dirty price is equal to clean price plus accrued interest, right? Discount rate is calculated on the face value, right? And most of the time banks uses 360 days in a year. Discount yield, if you go with the yield, it will be calculated on the issue price. Sometimes it is wrong to say discount yield. We can call it as an yield only. So just cross cross this. If it is discount, it will be on the face value. So discount yield, I am not satisfied with the formula. There might be some mistake in printing. So if it is yield, it will be calculated on issue price, and most of the time 365 days will be taken. Okay. So these are few things that you need to incorporate. Now, the term haircut is most commonly used when referring the percentage difference between an asset's market value and the amount that can be used as a collateral for loan. Assets market value and the amount that can be used. Okay, so basically, if you remember, the dirty price less haircut or initial margin is the amount of borrowing that was given by one bank to the another bank. It was discussed in the repo rate, the last topic. We will discuss this in mutual fund, holding period return, annualized yield on bank discount rate, discount basis is on face value, 360 days. It is again the same formula. Effective annual yield is based on your effective rate of interest, 1 plus r to the power n minus 1. And then money market yield is nothing but converting the holding period return into per annum return. So let's say, for example, you have held the investment for 30 days, and so this return of 5% will be for 30 days. So 360 divided by 30 will make sure that you are converting that 30 days return into per annum return. That is money market yield. Then we discussed some formulas for the portfolio management as well in the beginning, or before starting the chapter of risk management. The very first formula was for the return of the security, which is very simple: dividend plus capital appreciation divided by initial investment. If you remember the return for bond, it was coupon plus capital appreciation divided by average investment. In the similar way, we will calculate the return for equity share. Instead of coupon, we are getting equity dividend, and the capital appreciation will remain same, divided by initial investment. So this is the basic formula for calculating return of any investment: return in the numerator divided by investment in the denominator. But when there are multiple probabilities attached to the possible return, so let's say after 1 year, the return on my shares can be 10%, 20%, 30%, 40%, and if there are chances of happening of these different chances of happening of these returns, what we have to do is we have to multiply the return with the probability. This will give us the expected return. This was again done in that lecture. Again, portfolio return is very simple. If you have two different assets in the portfolio, and if you have invested, let's say 5 lakh and 5 lakh in each of them, the weight of both the shares in the total portfolio is 50%, and if the return of the first one is 10 and the second one is 12%, you can easily calculate 5% and 6% as the total return, and 11% will become the portfolio return. Understand? Okay. Then return of the security under CAPM, we will look at it after a couple of discussions. CAPM, arbitrage pricing theory, single index model and all. Acha, we are done with this one also. Understand? Risk means the standard deviation of a single security. We can calculate the formula, we can calculate the risk of the security without probability and with probability as well. If you remember, I will just show you. The beginning. Just give me a second. Yeah, this is basics before risk management chapter. If you remember, this return on investment is return divided by investment capital appreciation plus dividend divided by initial investment. Then we calculated it with the probability also. So expected return was nothing but RI into PI. Then we found, we discussed how to find the standard deviation. So we took the returns in one column, then probability in the another column, expected return in the next column, and after that it was the deviation. This is called as the deviation of return and expected return. So 20 minus 15 was 5%. Then what we did was, in order to remove the negativity, why negativity we have to remove? Because risk cannot be negative, so standard deviation cannot be negative. So in order to remove the negativity, we did the square of this column to arrive at all the positive figures. Then we multiplied this square with the probability to arrive at this column, and then at the end when we totaled all the numbers, it gave us variance, and we had to square root that variance in order to arrive at the standard deviation. Why we did that? Because the extra impact of squaring these figures was removed by putting a square root here. So that was the formula for standard deviation. Have a look. Ri, this return minus bar R will give you the deviation between two returns, and then you will do the square to remove the negativity, then you will multiply it with the probability, then you will do the summation, and then the square root. So basically you are going to go from inside to outside. If there is no probability in the question and still it is asking you to find out the risk standard deviation, you will have to divide it by n, calculate the deviation, do the square root, do the square, then total it, and then divide it by n, and then finally the square root to arrive at the standard deviation. Without square root, this is called as the variance. Okay. Then risk of the portfolio of two securities or assets. Risk of portfolio of two securities or assets. Till now, till this point, we use this formula to calculate the single security risk. But here we are going to calculate the risk and the standard deviation of the portfolio having two securities. We also saw this formula, but now we are going to calculate it in percentage. So once we have to calculate it in percentage, understand that the formula uses the weights. In value at risk or VAR chapter, the risk management chapter, we didn't use any kind of weights because we were calculating the variance in currency. While we have to calculate the variance in percentage, we will have to use those weights. So WA, standard deviation of A square, plus weight of B, standard deviation of B square, plus 2 into weight of A, weight of B, standard deviation of A, standard deviation of B, correlation coefficient of AB. Till this point, I think we have covered everything. Yeah, we also covered this one. No, I don't think so that we have covered this one. I will just talk about it in this lecture. So these are the formulas that were covered by us in the previous lecture. So what we are going to do, we are going to just start with the questions, basic questions which are going to be based on the concepts or the formulas that we have already discussed, and after that we will shift to some new concept. So I will just directly start with question number 1. Right, 95 questions journey will start from this point, sir. Have a look. This is the first question, basic question asked in May 2017 in new syllabus for 8 marks. A stock whose cost is 150 rupees, this is going to be P0, you can say, pays no dividend. So there will be no dividend in this case. So return, if you will calculate the return, dividend plus capital appreciation divided by initial investment, there is nothing called as dividend in this. So the entire return will be formed by the capital appreciation divided by initial investment. The possible prices at which the stock may be sold for at the end of the year. So you are starting this journey at 150 rupees by investing 150 in this stock, but there are multiple prices possible at the end of the year: 130, 50, 60, 65, 75, 85 and so on. What you have to do is you will have to calculate one single price of particular date in order to find out the expected return. But that's not the end. They are also asking you to calculate the standard deviation of the returns. That means you will have to find out the return at each point. If this is the particular, if the market price goes to 180, what is the return? 180 minus 150. So first create a column of one investment, then create a column of this, then third column will be the difference between 150 and this column, that will give you the returns in rupees, right? And then you will calculate the return in percentage. So I will just show you here. These are the possible prices. This is the return in terms of rupees, and this is the returns in terms of percentage. How you calculate it? It's very simple, sir. P1 minus P0 divided by P0. P0 is 150. This is your P1. You just find out the return. So these are the returns in percentages, but there are multiple return. Okay. Now you tell me one thing. If 13.33% is the return here, understand, and this is the price. If the 20% is the probability of happening of this price, can I say that 20% is also the probability of this return? Yes, sir. And accordingly, all the probabilities will apply to the percentage returns that you have calculated. What you have to do next is you have to calculate the expected return by doing this simple formula, Ri into Pi. Multiply all the probabilities with the return, you will get the expected return. Okay, fine. Then you will have to find out the standard deviation of the return. This is a single stock. You can calculate the standard deviation and the probabilities are given. What is the formula for that? Simply, first of all, take Ri minus bar Ri. Write down a column where you are calculating the deviation. Where you are calculating the deviation, there will be certain negative figures there. For that, you will have to do the square of all the of entire column to remove the negativity. Once you have removed it, multiply it with the probability column and do the summation. This will give you the variance, but you have to calculate the standard deviation, then put down the square. Okay, square root. Okay, so we have calculated the expected return first. We multiplied it with the probability. This is very simple. See, initially the questions are very simple, easy questions, so that's why I will move fast. I will stop at a point where there will be certain learning, and you have reached at these returns. So the average return is 6.667%. Now you are going to move ahead for the standard deviation. So 13.333 minus 6.67. Understand, 6.67, you will get 20% negative. So this is a deviation, this is a square of that deviation, this is a multiplication with the product. The total of it will give you the variance, and when you put a square root here, you will get the standard deviation. This is just a simple calculation. But now let me tell you something for which you have purchased the classes. Okay, so for the entire year, we can clearly say 6.67% will be my expected return. But the main problem is the standard deviation is 11.55%. So I can say that the 6.67% of the return can go up by 11.55% and can go down by 11.55%. So ultimately, what will happen? Your return can be 18.21% maximum, and it can also be minus 4.88%. So somewhere between minus 4.88 and 18.21 will be your final return. Understood? What are the formulas that you have learned in this question? These two are the formulas: Ri multiplied by Pi into summation, and then the standard deviation. Okay, easiest one. Very easy question. Okay, have a look on the question number 2. Following information is available in respect of expected dividend, market price and market condition after 1 year. Have a look. So good condition, normal condition, bad condition. The probability of happening of that condition is given to you. The market price will be 115, 7 and 97 at the end of the year. Dividend income is also given to you. The existing market price of an equity share is 106, which is come 10% bonus debenture of rupees 6. See, if you want to clearly calculate the value of equity share, you have to cut down that debenture which is included in 106 rupees. So 106 rupees is like equity plus debenture, and you want to calculate only equity's price, so deduct debenture from it, you will get 100 rupees of equity value. That's very simple, and 100 rupees is nothing but P0. Now what you can do is you can calculate the return in each case. First of all, calculate the capital appreciation. 115 minus 100. See, 100 and they have not given it here. So okay, 115 minus 100 is 15 rupees of the capital appreciation, 7 rupees of the capital appreciation. 97 minus 100 is minus 3 rupees of the capital appreciation. Now you have two different columns of the returns. Now you can do the total of it and you will get 24, 12 and 0. See, 20, 24, 12 and 0. Getting it? This is the net return in terms of rupees. Now the mistake that they have done here is they have calculated the return in terms of rupees, not in terms of percentage. But okay. 100 is the P0. So even if you want to calculate return in terms of percentage, it will come to 24, 12% and 0%. So the answer will be same. That's good. Now this much is okay with the question, but now Mr. X Finance Company Limited had offered the buyback of debentures at face value. That means they are going to buy it back. Okay, find out the expected return. How will you calculate the expected return? 24, 12 and 0 multiplied by this probability, 25, 50 and 25, and you will get the expected return. Variability of the returns given with the probability. You have to focus on one thing. The probabilities are given. So what will be the answer? Ri minus bar Ri square, then probability, then summation. Why are you doing this? Ri minus bar Ri will give you deviation from each point. To remove the negativity, square it and then multiply it with the probability, then do the total. This will give you the variance, and square root will give you the standard deviation. Okay, of the equity share if buyback offer is accepted by the investor, and also advise whether to accept the buyback or not. Now let's talk about the buyback first. The expected return comes to 12%. Standard deviation comes to 8.49%. Now focus on one thing. This equity share is giving you 12% of the return. Okay, 12% of the return. Have a look on this thing. Mr. X Finance Company has offered to buy back the debentures at face value. There is reasonable 10% rate of interest compared to the expected return of 12% from the market. Why to buy back is like your company is offering 12% rate of return as compared to the debenture interest of 10%. Now 10% will also become return because you are buying it back at face value. So market price and face value is same. Coupon rate and YTM will also be same. So on debenture, investors are getting only 10%. On debentures, investors are getting only 10%, while on equity share they are getting 12%. Okay. So considering the dividend rate and the market price, the credit worthiness of the company seems to be very good because they are giving good returns. The decision regarding buyback should be taken. Why? Considering the maturity period and opportunity in the market. See, the data first of all is not enough to justify whether you should buy back or not the bonds. Now, why the company will buy back the bonds is that they want to reduce the liability. First of all, if they have enough cash in their bank account, it's best to utilize the money in buying back. But if you have the cash in your bank account and you have a different opportunity in the market for expansion, then instead of buying back, instead of making the payment to buy back debenture, you should invest in the opportunity that you have. But if I say that there is no opportunity in the market, then yes, the buyback offer should be taken first of all. So that's what I'm talking about. They have also said that the maturity period, let's say for example, the maturity period is small. If the maturity period is low, say up to 1 year, it's better to wait and redeem the option instead of buying it back. So what all I want to say is, let's say for a company, they have a what we can say, debt in their balance sheet, and let's say that debt is anyhow is going to mature after 1 year. So the maturity period, when it's very close, why you want to involve yourself into buyback offers and everything? Just let the bond be continue with for another 1 year and it will be redeemed anyhow. But if you think that the bond's liability and the maturity will be there in the company for another 5 to 10 years, then you can think of buying back the offer, buying back the bonds and debenture, so that you can close it and do not continue it for the 5 years. But if anyhow the maturity is close, you should wait. If there is no other opportunity available in the market, you can buy back. You can invest the money in expansion plans or buying back. If there is an expansion plan, then go ahead with this thing. Wait for the buyback offer. If there is no expansion plan, buy back. If there is an expansion plan, do not buy. If the maturity is close, wait, do not buy back. If the maturity is long, buy back. That's the answer. Very simple. Okay, question number 3. Now let's discuss about question number 3. This question asks you to calculate portfolio return and portfolio risk. Two securities returns have been given to us, first of all. Second, there are no probabilities in this question. The number of years or the n in the formula will be 5. So let's read out this question. Security L and security K's returns are given in the second and third column. The first column pertains to the the year. Calculate the risk and return of the portfolio using above information. Now, let's have a look. This is risk and this is return. Risk and return. Now, what is the formula for risk and return of the portfolio? Just a second. Yeah, comfortable. First of all, let's write it down. Portfolio return is nothing but summation of RI weight I. Weight of individual securities in the entire portfolio. Again, R means the average return of L and average return of K that we don't know yet. So first we will have to calculate the average returns of both the securities. When there is no probability, what all you have to do is summation of all the return divided by number of observation. So 10 plus 4, 14, 19, 30 and 45. 45 divided by 5, it will be 9%. In the same manner, we will calculate the returns for K. It is going to be, let's say 5, 13, 18, 26 and 40. 40 by 5, 8%. So these two are the individual returns, average returns of both the securities. So we have reached at this level. We have calculated the returns of both the securities in the portfolio. Now is the time for the weight. Now, how much we have invested in L and K in the portfolio is not given in the question. When the weights are not given in the question and still you have to find out the same, you should take it equal, like 50% investment in each. Now we are going to calculate 9 into 50% plus 8 into 50%. So that's 4.5 plus 4, 9.5% portfolio return. That's your first answer, sir. Are you comfortable with it? Let's have a look. Okay. Sorry. This is how much? 8 point. The total is not 9. It was my mistake. 8.5%. 4.5 and 4. The same has been taken over here. See. Are you okay with this first return? You may ask from where the weights have been taken. When nothing is given, you have to assume the same, right? Now, let's talk about the portfolio standard deviation. Portfolio standard deviation means portfolio risk. Risk of the portfolio. Let me write down the formula. Risk of the portfolio comes from the variance of the portfolio. And now variance of the portfolio has its own formula. Weight of A, standard deviation of A square plus weight of, instead of A we are going to take L and K. So weight of L, standard deviation of L square plus weight of K, standard deviation of K square plus 2 into weight of L, weight of K, just a second, standard deviation of L, standard deviation of K, and RLK. You remember about this concept of correlation coefficient? It represents the correlation between both the securities. When one security is going up by 10% and the correlation coefficient is 0.6, the other security will go up by 0.6 times of the first security, that is 6%. 10 into 0.6. Okay. So in this question, we have already assumed about the weights of both the securities. So only three figures are required. First of all, standard deviation of L, standard deviation of K, and RLK. So let's talk about all these three one by one. First we will calculate this, then this, and then this. Okay. So let's focus on standard deviation. Now you can see here, standard deviations formulas have been given already. This is what we learn. We have to first calculate the deviation between the bar R and the normal R. This is bar. Once you calculate the deviation, you have to square it, and since there is no probability, we will do the summation. Now there is one problem, or we can say the printing mistake. There has to be a summation here. So please, my request is there, do this in the formulas. So what we are going to do, we are going to take the deviation and then square it to remove the negativity, then do the total and then divide by number of observation and then square. I will just write down all these steps here. First, deviation. Second, square to remove the, you don't have to mug up all these things. I am writing the steps, that doesn't mean you will have to mug up. You need to understand the process. First you will calculate the deviation. To remove the negativity, you will have to do the square. There is a reason for the second step instead of mugging it up. Then do the total, then do the divided by number of observation, and then put a square root to remove the square impact. Okay, cool. And this way we will calculate the standard deviation. So have a look. This is the deviation column. 10 minus 9 1, 4 minus 9 5, 5 minus 9 minus 4. Okay, if you are doing the practice in this way, the way I am explaining, then you are doing wrong. See, I am on the other side of the table. My job is to make you understand things. But unless and until you do the practice with your own pen and own register, not this, own register, you won't learn anything. I am explaining this to make you understand the concept, but there is no shortcut to the practice. So imagine you watching the videos on YouTube of how to drive a car, and you have watched it for n number of hours. Will you learn perfectly how to drive a car? Will you learn to drive a car perfectly? No, sir. Unless and until you practice the things that you have watched in a video, you won't learn to drive. So yes, watching the videos are important, but then practice is more important than that. So if you do this, what I am doing, then my job is over. Right? You need to practice this, and I'm assuming you have come here after practicing the question, and then you are watching the video, and now it's all up to you. Okay, I will move ahead. So we will calculate the deviation, then to remove the negativity we will do the square, then total 82. In this manner we will do it with the second security as well, total 266, and then we will find out the standard deviation. So 82 by 5 number of observation, and then square root 4.05, 266 by 5, then square root 7.29. okay, so we have arrived at the standard deviation of both the securities. So this point 1 and 2 is over. Now let's talk about the third point. Correlation coefficient of L and K. We have learned about the concept in the basics before value risk management topic, but then we didn't learn about the formula to calculate RLK. Okay, correlation coefficient of L and K. But before that, I think we should learn about the covariance, because the correlation between I will just write down correlation between the two securities depend upon the risk of the two securities. Now, what is the formula for variance? It is nothing but standard deviation square. This is how we represent variance, and standard deviation square is nothing but Ri minus bar Ri, and then we do the square, right? If there is probability, we will multiply it with the probability, otherwise we will do the summation and then divide by n. Am I right with the formulas? Okay, so can I write down this formula as summation of Ri minus Ri bar Ri into Ri minus bar Ri, again because it is square, right, divided by n. Are you okay with this formula? Cool, sir. Now I can clearly say that this variance is of single security, which is I. But if we want to calculate covariance, then we will have to multiply the variance of, or the risk of, two securities together. So covariance itself means the risk of two securities together. So that doesn't mean you will multiply standard deviation square I, standard deviation square L, or whatever. It simply means that instead of multiplying the risk of the single security with the risk of the same security, say, can you understand one thing? I have multiplied the deviation of ith security with itself. Ith security with itself. So this is the variance of the single security with itself, but it is not with the other security. If we want to calculate the covariance, we should take the deviation of single security and the deviation of the other security, first security and the other security. In our question, it is L and K. So if we replace the securities, have a look, summation of RL minus bar RL, RK minus bar RK divided by n. Now what is the difference between the formula written just above that and this one? It is simple. We are multiplying the deviation of this security with the deviation of the same security. That is simply variance. But multiplying the deviation of one security with the deviation of another security is called as covariance, and this is the formula for covariance. First, have you understood the concept? Okay, do you need to remember anything new to remember this formula? Do you have to mug up anything? No, sir. This particular formula of covariance comes from the basic formula of standard deviation that we have learned. Okay. Now, this covariance shows the risk of the two securities together, not individually but together. Now, what happens because of that is the risk gets reduced when you combine the two securities and bring it at one place. This gives us the idea of the correlation coefficient. Correlation says that what is the exact risk what is the exact risk as compared to the product of the risk of the two individual securities. Now have a look. Coefficient of correlation coefficient R is equal to covariance of LK divided by standard deviation of L and standard deviation of K. Now understand the concept. The numerator also specifies the risk, denominator also specifies the risk. Cool. This is also variance, and when we multiply the two standard deviation, this is also variance. This is the variance of LK, this is also the variance of LK. Sir, everything in the numerator and denominator is same, but then why we are doing all these things, but why the figures will be different? So if you calculate the covariance of LK, let's say it comes down to L80. But this 80 is the risk when you combine the two securities in a single portfolio. But if you want to find out the risk of individual securities, the risk of L and risk of K separately, then the separate risk of both the securities, let's say, is 100, 10 into 10 or 20 into 5, whatever the numbers are. 20 is the risk of, let's say, L, and 5 is the risk of K. So when you multiply 20 into 5, you will get 100 and the answer will be 0.80. Now you should be able to analyze and understand the answer. This says that the separate risk of both the securities is 100, but when you combine the two securities, it brings the magic of diversification, the magic of risk reduction, and the total risk comes down to 80. So 80 is the risk when you put both the securities together, and 100 is the risk when you put both the securities separately, individually. Okay, so 0.80 is the ratio of the combined securities, the securities put together and the securities put separately. 0.80 is the ratio. So it says that how the market is going to behave, how the first security, how as compared to the first security, the second security is going to behave. 0.80. Are you okay with this? Are you okay with this? Since it is the ratio of risk versus risk, but this is put together, this is separate. That's it. Both the numerator and denominator are variance itself. That's why we are calculating a coefficient, means a number which says that how much risk can be reduced. If the number is 1, that means 100, right? Now how to interpret it? That there is no benefit of combining the two securities in a single portfolio, as the risk put separately was 100 and the risk put together is also 100. There is no reduction in the risk. There is no benefit of creating a portfolio. So when correlation coefficient is 1, you do not reduce the risk. You are not helping in risk reduction. The two securities are useless. Useless means they are not helping in risk reduction. Okay. Have you understood the concept of coefficient of correlation? I will talk about it more in the coming questions, but for this question, it's enough. So this is the formula that you have learned, and actually we have derived it, right? So let's find out the covariance. Let's find out the covariance now. What we have to do in order to find out the covariance between the two securities? Why we have to find out the covariance? See, this is our main formula for calculating the portfolio risk. We need RLK, and RLK depends upon the covariance of LK and standard deviation of both. We have already calculated the standard deviation of both, this one and this one, right? 4.05 and 7.29. We have already done that, but covariance of LK is pending, and this is the formula for that. Take the deviation of first security, multiply it with the second security's deviation, do it for all the 5 years, then do the total and then number of observation, divide by it. So this product of deviation, see. This is the deviation 1, this is the deviation 3, 3 into 1, 3. Minus 5 into minus 14, 70. Minus 4 into 5, minus 20. In such a manner, we kept going on for all the 4 years and we did the total 89. Then divide by 5, you will get the actual covariance. You will get the covariance, where it is? Sir, here. 89.5, 89 divided by 5, 17.8. So now you can put down 17.8, understand? 17.8 in the numerator divided by individual risk 7.29 into 4.05, that's 29.52. I can write down 29.52. What does that mean? The risk of the two securities separately comes to 29.52, but combined is only 17.8. That means yes, there is a risk reduction. Risk is reducing. So the answer will be 17.8 divided by 29. 17.8 divided by 29.52. That's 0.60. Right? So you can put the 0.60 in the formula. This 0.60. Now there is one more technique that I can help you with. See, if you take the formula of coefficient of correlation, it says that R is equal to covariance divided by standard deviation of L, standard deviation of K. The entire denominator can be transferred to the left hand side and it will look like this. R, or we can say standard deviation of L, standard deviation of K, RLK is equal to covariance of LK. So this can be another formula to calculate covariance of LK. Now you can see this much of the data, both the standard deviation and RLK. See, have a look on this side. This is both the standard deviation and RLK. That means in place of this entire 3 figures, you can just put one concept, which is R covariance of LK, and you will get the same answer. Understood? So they have done it like this: weight into standard deviation square, weight into standard deviation square, plus 2 into weight into covariance of. This is in place of all the 3 figures: R standard deviation, and RLK. The answer comes to 5.125 square. Please understand that this is only variance, and then you put a square root over this, you will get the standard deviation of portfolio. So this is the portfolio return, this is the portfolio standard deviation. Practice makes man perfect. See, question number 4 is similar to question number 3. The only new things which have been given we are going to discuss. The 2 securities are given to you. Instead of the return, they have given you about the market prices in rupees, not in percentage but in rupees. Okay, so for 1, 2, 3, 4, 5, 6, 7 years the data has been given to you. The risk and return by investing in stock A and B. We have to calculate the risk and return by investing in stock A and B. I don't know why they have not given the initial market price. That's all fine. See, when the initial market prices are not given, then you cannot take the first year, because we will assume that we have purchased the stock at the 2013's prices. So the first return can be calculated in this year. In total, we will have 6 years instead of 7 now. Because the initial price, the purchase price is not given, we will assume that we have purchased the shares at this price, the beginning price. So when you will calculate the return, the first return will be calculated for this year, 13-14, second, third, 4th, 5th and 6th. That's it. Only 6 years are there. Okay. So how to calculate it? Take this one as P0, this one as P1. So P1 minus P0 divided by P0. Right? In this manner, you can calculate the first year's return. And for the second year, this will become P0. and this will become P1. Then this P0, P1, P0, P1, P0, P1. In the same manner, you can calculate the returns, first of all, for all the stocks. Then you do the average. Do the total of that, summation of return divided by number of years, that is 6. And also calculate the risk, R minus bar Ri. It's very simple. Have a look. So you can clearly see 2013 year has been left from the calculation, and then only 6 years has been taken. These are the returns, this is the total, and this is average. 83.95 divided by 6. Yeah, 13.99, that's 14%, you can take it directly. This is the deviation. Then this is the deviation square, total of the deviation square, right? And divide by n, that means divide by 6. Divide by 6, divide by 6. You will get the variance. Okay, and you do the same thing for B also. Percentage return, or I can say R, right? This is Ri, this is a bar Ri, average divided by 6. Okay, Ri minus bar Ri, this is Ri minus bar Ri square. This is the total. When you divide the total by 6, you will get the variance. Okay, and this is for the calculation of covariance. What they have done is the deviation of A multiplied by deviation of B. This is for the calculation of covariance. The total of this is 96 divided by 6 is covariance. Okay, now they asked us about the return of A and B. This is the return of 13A and B. Then the risk of A and B. Square root of this and square root of this. That was variance. When you do the square root, you will get the standard deviation. So all the figures are in percentage. Then the risk and return by investing in a portfolio of these stocks if we invest in the stock A and B in the proportion of 6:4. In the previous question, the weights were missing, and that's why we took 50-50%. Now you have to take 0.6 and 0.4. That means 60-40%. And then calculate the return of the portfolio. What is the return of the portfolio? Summation of Ri into weight I. So weights, so you have 60-40. Returns are here 13.99 and 16.19. Then comes to the point of risk. Please understand, risk of the portfolio having two securities needs 5 different figures. What are those figures? I will tell you. First one, weight of two security, weight of A and weight of B. We have both the figures. Then standard deviation of A, standard deviation of B. We have these two as well, right? And then the last figure is RAB. For RAB, we need covariance of AB, and covariance of AB is this. See, so return of the portfolio is okay. Risk of the portfolio, in risk of the portfolio, what will happen? Why they have taken 0.602? So just remove this and remove this. 402 and 602. This is a printing mistake. 0.60 and 0.40. Take this much only. Then go ahead, 2 into weight of A, weight of B, and then this covariance. I will just write down the formula here. Weight of A into standard deviation of A. Okay. That 2 was nothing but the square. And there is a printing mistake. That instead of square, it has been, this is 2 square. It is square, right? That 2 should have been on the square. Okay. Standard deviation of A square, which is already 1037. This is nothing but the standard deviation of A square, variance of A. So weight of A square, standard deviation of A square plus standard weight of B square, standard deviation of B square plus 2 into weight of A, weight of B, covariance of AB. I am just writing it directly. Instead of entire standard deviation of A, B and RAB, it should be covariance of AB. Now, the better opportunity for investment. On the basis of return, B is preferable. Why return B is preferable? See, if you go with the returns, you can see we are getting more return in B. But if you go with the basis of risk, also B is preferable because the risk is lower in that. So lower risk and higher return is preferred by any investor. On the basis of risk of the portfolio, on the basis of return, B is preferable, and on the basis of risk, portfolio investment is preferable over the individual stock. See, yeah, that is actually good idea. If you can see the risk of both the securities, it is 32 and 24%, but the risk of individual, the entire portfolio comes to only 21%. Instead of 32% and 24%, don't you think 21% is a lower risk? So if you want to have a low risk portfolio, go with the portfolio, otherwise invest in B, because investment of the portfolio is giving you only 14.87 return. So you are getting higher return in B as compared to the portfolio. But in terms of risk, portfolio is preferable because it has a lower risk than both the risk of the securities. Okay, that's good. Question number 5 is there, and it is going to be an interesting one. Standard deviation of the first security is given to you, and the second security is also given to you. Then they have also given you the weight of A and weight of B. The only figure that is missing to calculate the risk of the portfolio, see, standard deviation of the portfolio, is correlation coefficient, which is also given to you here. Sir, all the 5 figures which are required to calculate standard deviation of the portfolio is given in the question. Then what is that that we need to learn in this? It's very simple. We are not learning the calculation in this question. We are learning the concept. This +1 means perfectly positively correlated. Perfectly negatively correlated and uncorrelated. No risk reduction when R is equal to 1. Highest risk reduction when R is equal to -1. And there is some kind of risk reduction also when R is equal to 0. So that is what you want. You will have to learn. But then the formula comes to this. See, the normal formula for calculating the portfolio risk is this. Do you agree with this? Weight of A, standard deviation of A square, plus weight of B, standard deviation of B square, plus 2 into weight of A, weight of B, standard deviation of A, standard deviation of B, RAB. But then if you replace, all the figures are same in all the 3 variables, only you will have to change R to 1, -1 and then 0. So let's first put 1. The moment you put 1, it is as good as multiplying any figure with 1 or not multiplying at all. So if you do not multiply, the formula will not include RAB. And if you skip that, then you will realize this is A square plus B square plus 2AB. Simply. So instead of this, when R is equal to 1, you can reduce the formula itself to this. Weight of A, standard deviation of A, plus weight of B, standard deviation of B. That's it. You don't have to do this much. Let's find out. Weight of A is 40%, standard deviation of A 40, plus 60% into 20. So that comes to 16 plus 12, 28. Now you tell me, will you go with the entire formula or the shortcut? It's nothing but the weighted average. Right? So when correlation coefficient is 1, first it is called as perfectly positively correlated. Second, you cannot reduce risk when R is 1. You cannot reduce risk in the portfolio. So I am just writing few things. Perfectly positively correlated, we cannot reduce risk in this case. Yeah, this is what I was talking about. Go with this. And when r is equal to -1, simply the same formula, in place of plus sign it will be minus. So have a look. When you put -1, it is as good as multiplying with nothing but changing the sign to minus. So this sign of plus will become minus and your formula will look like this. The difference of the weighted average. Weight of A, standard deviation of A minus weight of B, standard deviation of B, 16 minus 12. Earlier it was 16 plus 12 and now it is 16 minus 12 and this is your new answer. Comfortable with this? This is called as perfectly negatively correlated. Now the last part. When you put 0 in the formula, what happens is, see, anything multiplied by 0 will become 0 only. So this entire portion, let's go to the original formula. This, after this plus sign, the entire portion will become 0 and the only thing left in the formula is square root of weight of A, standard deviation of A square plus weight of B, standard deviation of B square. That's it, nothing else, this much. Put down the figures, calculate the answer and finish it off. Standard deviation of P. So there are three things that we have learned. When correlation coefficient is perfectly positively correlated, we cannot reduce the risk. When it is perfectly negatively correlated, we can reduce the maximum risk. And when it is uncorrelated, yes, there is risk reduction, but not that is somewhere in between, middle we can say. Come on to question number 6. So let's read. There are 6 securities given to you, A, B, C, D, E, F. The returns are also given to you in this question and the risk of all the securities. First thing that they are asking us is, assuming 3 will have to be selected. Only 3 securities will have to be selected. You have to tell them which one. Out of 6, only 3. So first, let's start with security A. It has 8% return and 4% risk. Just stick to it right now. I'm not saying select this one or that one, but we are going to compare these returns and risk with the other security. Now, if you compare A with B, we can clearly say that we are getting the same level of return with lesser risk in A. The risk is lesser in A. So whosoever is going to invest in B, we will suggest him to invest in A because 8% is the same return that he will get in A, but the risk will be lesser. So all the investors who were planning to invest in B will come to A. So we can clearly say that A is dominating B in terms of same level of return with lesser risk. This will be eliminated. B has been eliminated. No one should invest in B. Then comes to C. If we can compare with this, the return in C is higher than A. The risk in C is also higher than A. So A is also okay with in its place and C is also okay in its place. Also, we can clearly say that we will just continue with this. I'm not saying choose C forever, but yeah, we are going to continue with C as of now because A is not dominating C, neither C is dominating A. So both the securities have been continued. Now comes to D. If you compare A with D, you can clearly see that the risk in D is same as A, but the return is lower. So why would you invest in such a security where the risk is same and the return is less? Instead, all the investors of D are suggested to invest in A because they will get higher return with the same level of risk. 4 is the same risk and 8% is the higher return. So in this case, security A is dominating security D and D will always get eliminated. Now comes to E. Now comes the picture to E. When you compare E with A, we can say that E has a higher return, also higher risk. So both the securities will continue. As compared to C, E has lower return and lower risk. So again, both will continue. So we'll continue with E. Then comes this picture of F. We can clearly see that A is dominating F. Why and how? The return is 8% in both, but the risk in F is higher which is wrong, which is not good. So F will also get eliminated by A with the concept of same return and lesser risk in A. So the three securities that got eliminated by security A is B, D and F. You are not going to invest in this, this and this. And the rest of the three securities which are selected is A, C and E. So these are the securities selected. See. Hence the ones to be selected are A, C and E. Now the picture. Assuming perfect correlation, they have not told us positively or negatively. When nothing is given in the question, we will assume it as a positive correlation. What does that mean? Whenever the positive correlation is there, you are never going to reduce the risk. Still, let's give it a moment. Whether it is preferable to invest 75% in A and 25% in C, or invest 100% in E. Now what they are asking you to do is whether you should create a portfolio of A and C with 75 and 25%, or whether you should keep investment in E 100%. So let's compare the return and risk of that portfolio and E. We know that the return of E is 9 and the risk is 5. Let's calculate the portfolio return of the portfolio with A and C. Okay. So you can see that the return of A is 8% and return of C is 12%. Portfolio return says that weighted average is the formula. So 8% into 75% plus 12% into 25, we will get the answer of 6 plus 4, 8 into 0.756, 12 into 0.25, 3. So that's 9%. So the return of the portfolio is 9%. As compared to return, when we take the basis as return, portfolio and E are giving, both are giving same return. So still, now we can clearly say that the entire picture now depends upon the risk. If the risk of the portfolio is lower, we will go with that. Otherwise, we will go with E. Now let's calculate the risk. While calculating the risk, you came to know that the relation between both the securities is +1, and we already saw this in this formula in the previous question, that when the correlation coefficient is 1, the formula of risk of the portfolio is nothing but the weighted average, that is weight I and standard deviation I. So 0.75 into the risk of A, which is 4, plus 0.25 into the risk of C, which is 12. So 3 plus 3, 6%. Now we can clearly say that security E wins the race. Why? Because it comes with the same level of return and lower risk. The average values of for A and C for proportion of this 6 and 9, and we can clearly say that this for the portfolio it is 6 and 9, E 5 and 9. So E won the race because it has lesser risk as compared to the portfolio. So we will suggest to invest entirely or 100% in E only. That was the question. Question number 7 is going to be the next question, where you already know how to calculate the return of the portfolio weighted average. It is nothing but summation of weight I RI. You have been given with the returns, and weights are also given to you. Weight of A, weight of B. Okay. Variance of the portfolio, it's very easy to calculate. All the 5 figures 2, 2 and 1 have been given to you. You can calculate the variance. When you will just put a square root to the variance, you can calculate the standard deviation. So that's also okay. The only thing that I am taking this question is the part number 4. State whether diversification has resulted into risk reduction. What kind of diversification we have made? We have invested in 2 securities and created a portfolio A and B. So the risk of the portfolio A and B comes down to 17.09%. Okay. The actual risk of the portfolio comes to 17.09%. And now we have to explain whether the diversification that we have made has actually reduced the risk. and we are going to compare it in an opposite manner. If there would not have been any kind of risk reduction, no risk reduction means R is equal to 1. I just told you in the previous question, the previous of the previous question. Then when R is equal to 1, there is no risk reduction. See, I will tell you again. R is equal to covariance divided by standard deviation, standard deviation. When the actual risk is 100 and the risk individually is also 100, the R will come to 1. And you can clearly see that there is no risk reduction in the numerator. Covariance is also coming to 100 and the individual risk is also coming to 100. When there is a risk reduction, this figure is not same as the denominator. It should not be. So when R is equal to 1, we can clearly say that the risk reduction doesn't happen, and means R is equal to 1. And if R is equal to 1, can I say that the portfolio risk is nothing but the weighted average? Weight of A, standard deviation of A, plus weight of B, standard deviation of B. So the weights are 0.40 into standard deviation 20 and 0.60 into 25. Have a look. 8 plus 15. Am I right? 40% in A. Sorry, I have taken wrong figures. It should be the risk, na, 50 and 30. So 50 and 30. 20 plus 18, that's 38%. That means if you do not reduce the risk of the total individual securities put together is 38%. But our question is giving you this answer 17.09, which is lesser than 38%. What does that mean? Yes, we have succeeded in reducing the risk of the portfolio, and there is no need to reach out to this place. See, when R given in the question is minus 0.60, we can clearly say that yes, risk reduction is happening, because if there is no risk reduction, R has to be 1, and if R is anything but 1, there is a risk reduction. You can take 0.98 also, you will find the risk reduction. See, this is the entire picture. I will just go with this line, okay? Minus 1, 0 and plus 1. This is correlation coefficient. Risk reduction doesn't happen only at this place. And with the rest of the places, you can clearly say from the end to this point, area of risk reduction. Means I can clearly say that when R is anything but 1, positive 1, risk reduction is happening. And in this case, we can say that R is minus 0.60. Risk reduction is there. So yes, diversification has resulted into risk reduction. Come on to question number 8. Now question number 8 is little different in terms of risk. See, I will tell you one thing. We learned about how to calculate a standard deviation of a single security. It was like taking the deviation first and doing the square to remove the negativity, and then multiplying it with the probability if there is any, then doing the summation, and if there is no probability, divided by number of observation, and then put a square root. This is how we calculate the risk of a single security, single asset. But if we had to calculate the risk of the portfolio having two securities, 2P means the portfolio with two securities, we were using this formula of standard deviation of A, weight of A square, plus standard deviation of B, weight of B square, plus 2 into weight of A, weight of B, standard deviation of A, standard deviation of B, RAB. Sorry for that accent. and then putting up a square root. But now I want to find out standard deviation of the portfolio with the 3 securities in that. 3 securities. This is called as Markowitz model. This entire concept is called as Markowitz model. So if in any question they ask you calculate the risk according to Markowitz model, don't get afraid or scared. They are asking you the same thing. Now the question is how to calculate standard deviation of a portfolio having 3 securities in that. Remember, standard deviation of a portfolio having 2 securities in that had this formula of A plus B whole square. 2 securities only in the bracket. But now we will have A plus B plus C whole square simply. What we did in the previous case was in place of A, we put standard deviation of A, weight of A. In the similar way, we are going to do it with this. So the formula will be like this. A square, first of all, let me just go through step by step. A plus B plus C whole square, which will be A square plus B square plus C square plus 2AB plus 2BC plus 2CA. Now you have to expand that entire formula to something else. In place of every A, B and C, you will have to put standard deviation of A, weight of A, standard deviation of B, weight of B, standard deviation of C, weight of C. And everywhere 2AB is coming, you have to put RAB, RBC, RCA. Remember that last part? It is the correlation coefficient between 2 securities. So there will be 3 correlation in this question. A with B, B with C and A with C. That's it. This is the formula. You can solve this entire question later on. So I'm just writing it entirely. Have a look. This is the square then. After putting a square root, you will find the answer. Okay. So standard deviation of A, weight of A square plus standard deviation of B, weight of B square plus standard deviation of C, weight of C square. This is A square plus B square plus C square. Then plus 2AB. Have a look. 2 into, you are just going to repeat it 3 times. Weight of A, weight of B, standard deviation of A, standard deviation of B, RAB. This was all about AB plus now BC. 2 into weight of B, weight of C, standard deviation of B, standard deviation of C, RBC. That was with BC. Now with CA. 2 into CA, AC, anything. 2 into weight of C, weight of A, standard deviation of C, standard deviation of A, RCA. That's the entire formula, and this will give you the portfolio variance with the 3 securities in that. Then the final answer has to be square root. Then you have the answer with you. This is A plus B plus C whole square, A square plus B square plus C square plus 2AB plus 2BC plus 2CA. Put down the values and you will get the answer. That's it. Have a look on this question. I'm not going into the calculation. You have to do the practice by your own. If you lose it on the practice, you will lose it in the exam for sure. Security XYZ. These are the weights. These are the standard deviation and these are the correlation coefficient. What else is required? Every figure is given to you. Every figure. Then correlation these are the correlation coefficient, and it may be noted that the correlation coefficient between X and X, Y and Y, and Z is 1. Obviously, need not be told, right? X with X is 1 only. X is going by 10%. X is going by 10%, obviously. So I'm not going into the calculation. You just put down the figures and try solving it. You will get this answer. Okay. Conceptual clarity is the only thing that I need to explain. Okay. So have a look on question number 9 now. And it's again an easy question. See, what has been given in the question is the returns for the security A and B, but that is given for 2 years. Just like it was given for 5 years in the previous question. Do you remember this one? This question? 6 years, and this one 5 years returns were given to us. How did we calculate the average return? We calculated the total of all the 5 years and then divided by 5. When probability is not given, you do this. Okay. Similar way, we are going to first calculate the average return of both the years. So I can clearly say that 10 plus 16, 26 by 2 is 13%. 12 plus 18, 30 by 2 is 15%. These are the average return of each year. Expected return on portfolio. They are not asking you to calculate A and B's return. They are asking you to calculate the return of the portfolio with this much of the investment, 40 and 60%. So portfolio return is nothing but weighted average. We have the weights of both the securities, we have return of both the securities, we can easily calculate that. Then comes the standard deviation of return from each of the two stocks. Every stock's standard deviation, and you understand one thing, the difference between 13 and 10 is 3%, 16 and 13 is 3%. The difference between 12 and 15 is 3%, 18 and 15 is 3%. Equal distance from everywhere. How the answer is going to be? See, 3% and 3%. That's it. From all the sides it was 3%. So obviously the standard deviation has to be 3%. When only two returns are given, see, when only two observations are given and your average return comes in exactly between the two, then calculating standard deviation is very easy. That's the difference. Standard deviation itself means 3%. 3% of the standard deviation. What does that mean? That your return can go up to 16%, 13 plus 3, 13 minus 3, 10%, and these are exactly the answers, right? Then covariance of the returns from the two stocks. Covariance of A and B. What are you going to do now? This is R minus bar R. This is A and this is B. It's simply 3 into 3, 9. Why? I will tell you. See, R minus bar R, 10 minus 13, 16 minus 13. Then in that case, 12 minus 15, 18 minus 15. The answer everywhere will be 10 minus 13 minus 3. This is minus 3, this is 3, this is 3. So 3 and 3, 9, 9. 18 divided by 2, again 9. This question is very easy, man. 9. Right, covariance is done. Now comes the correlation coefficient. It's also again very easy. Correlation coefficient is nothing but covariance divided by the product of the standard deviation of both. In a sense, both of the numerator and the denominator are the variance. Okay, both are the variance, but the main problem is this is actual variance when you combine the two securities in a portfolio, and this variance means the risk of product of the risk of the two is taken separately. It is the variance when taken separately. So it is coming to 1 only. 9 and 9, that means perfectly positively correlated. That means there cannot be any kind of risk reduction. In this question, if they ask you to calculate risk, do the weighted average, because R is 1. You can reduce the calculation. So they are again asking you to calculate the risk of the portfolio. It is very simple. Weight of A, standard deviation of A, weight of B, standard deviation of B. Don't go into that long formula because we have just got to know that R is equal to 1. So go with the shortcut method and save up on time. So that was all about this. See, they have done it like this. 3 into 40% plus 3 into 60% is nothing but 3. 3. I'm leaving this question for your homework, and this is also easy. See, in all and all, there are 4 different situations. Okay, 4 different situations where the weights are changing, and in every situation they are asking you to calculate return of the portfolio and risk of the portfolio. Risk of individual securities have already been calculated. Return of the individual securities have already been given to you. The only thing that is changing in every case is the percentage of investment in everyone. So this is only 100% investment in B. So what is the return and risk? This is the return and risk. Simple, 10 and 12. In this case, 100% in D. This is the return and risk. That's an easy question, brother. 50% in B, 50% in D, weighted average. 75 in B and D, weighted average. And then you have been given with the correlation coefficient also. Put down the figures in the formula, you will get the answer. That's it, nothing to learn more about it. Okay, question number 10 is also, I am considering completed. Question number 11 as well, I think, but let's have a look on that. 11 also is pretty same. So in this question also, what has been given to us, let's see, construct a portfolio of security X and Y. So security X and Y are given, the returns of the two securities, the risk of the two securities. Then they are saying that Mayuri has 5 portfolios of X and Y as follows: 50% in each, 75 and 25. So these are the weights, I can say this is 50 50, 75 25, 25 75. Okay, only the weights are changing. 60 40, 35 65. Coefficient of correlation is 0.16. Expected return under different portfolio options. So you have to calculate 5 portfolio return. It's very easy. Summation of weight I RI. That's it. Every time you have to do the multiplication with weight and return. Risk factor associated with these portfolio options. You have to calculate the standard deviation of portfolio 5 times. Only thing that is changing in the formula is the weight. Okay, which portfolio is best from the point of view of risk and which portfolio is best from the point of view of return. From the 5 answers that you have calculated in the second part, see, this is related to the second part and this is related to the first part. So whichever option has the lowest answer, means lowest risk, that option is best. And in the fourth one, you will have to look at the first answer. Whichever out of the 5 has the highest return will be preferred. That's it. Easy question. For 8 marks, I don't know why. In October 21, they have asked for 10 marks. It is never going to come for 10 marks in real exam. It was the mock test paper. Okay, let's move on to question number 12 now. Question number 12 and 13 are same. I think. Yeah. Let's take question number 13 and skip question number 12. Why, I will tell you. Question number 12 is a smaller version of 13. So 12 ends here, but 13 keeps going on till that point, till this point. Right, so I will just take 13 and I will keep 12 as an homework for you. Have a look on this question. Mr. A high net worth individual, invested on 1st April 2014 in certain equity shares as below. So what he did is he invested in X Limited shares and Y Limited shares. The number of shares that they have invested is also given to you, 1 lakh number and 550,000. Then this is called as the face value. This is called as the numbers. This is the cost. You can actually calculate P0, the price at which you have invested. 2 crore divided by 1 lakh, 200. 1 crore 50,000 divided by 50,000. 1 crore 50 lakhs divided by 50,000, that's 300. So this is the price at which you have purchased the shares, P0. In September 2014, just understand, from April to September, 10% dividend was paid out of X Limited. Consider this as rate, and rate will be applied on the face value. When nothing is given as to which kind of percentage is that, you will have to understand or consider it as rate. So dividend rate of 10% means 10 rupees on 100 was paid out by X Limited, and in October, the very next month, 30% dividend was paid by Y Limited. So we can clearly divide the entire thing in 2 different years. Okay, you purchased the shares of X and Y at this place. It costed you around 200 rupees and 300 rupees. Okay, then what happened in the same year? The dividend was paid 10 rupees for X and around 30% of 10 rupees, which is 3. Okay, on 31st March 2015, by the end of the year, because we started at April 14, market quotations showed a value of 220 and 290. So the closing prices are 220 and 290 per share for X and Y Limited respectively. On 1st April 2015, the technical analyst indicated as follows that the probabilities of dividends from X Limited and Y Limited for the year ending 2016 means this point are as below, that there are 20% chances X will declare a dividend of 10% and Y will declare a dividend of 15%. And then there are this much of the chances for this much of the dividend, this much of the chances for this much of the dividend. Okay, I will write down the values. If 10% is declared, it will be 10 rupees, 15 rupees and 20 rupees. But if 15% is declared, it will be 1.5 rupee, 2 rupee and 3.5 rupee, because the face value is 10 rupees. Okay, so these can be the dividend in that year, in the second year. For the first year, the amount of dividend is very clear, 10 rupees and 3 rupees only. But in the second year, it can be 10 and 1.5, 15 and 2 and 20 and 3.5, and there are 3 different probabilities for that. That's okay, we can calculate it easily. That the probabilities of market quotation on 31st March 2016, the previous probabilities was for the dividend, and these probabilities are for the market price, that is P1. Let's compare the probability 20%, 50 and 30%. This is also 20, 30 and 50. Please understand, this is 20, 30 and 50 and this is 20, 50 and 30. So there is a variation in the probabilities. You are required to analyze the average return from the portfolio for the first year. Analyze the expected average return from the portfolio for the second year. So first of all, you will have to calculate the portfolio return only. Portfolio return, summation of RI into WI. And now you will have to first calculate the weights of both the securities in the portfolio and return of both the securities in the portfolio. First of all, let's go with the weights. You can clearly see that weights are always calculated based on the beginning price of the year. So beginning value of the portfolio of the year is 2 crore and 1.5 crore. So 3.5 crore is the total value. So 2 divided by 3.5. That means the weight comes to 0.5714 and 0.4286. These are the weights for the first year. You are done with the weights. Now is the time to calculate returns. Return, how do you calculate the return? It can be clearly seen in the question in the very first year what is happening. There are no probabilities in the first year. You purchased the share at 200, the dividend is 10 rupees and the price is 220 at the end of the year. So you can see there is a 20 rupees of the capital appreciation, right? So dividend plus capital appreciation divided by initial investment, you will get the individual return of the securities. Now let's start with the answer. See, 10 rupees dividend, 20 rupees capital gain, total gain is 30 rupees, investment was 200. So 30 divided by 200 will give you 15%. And the weights of the portfolio are, I don't know why they have taken it entirely as 57 and 43. It should have been 0.5714 and 0.4286. In the similar manner, you will calculate the return for Y. The dividend is 3 rupee. Capital loss is there for 10 rupees. Net loss is 7 rupees, 10 minus 3. And 7 divided by 300 is the total return of Y. When you multiply this return with the weights and do the total, you will get the portfolio return. Instead of an equation format, they have done it in the table format. The answer will be same whether you do it like this or that. If you have a question whether I will get the marks if I solve the question according to my own format, yes sir, 100% you will get the marks. Be clear about the answer. You should highlight the answer like this, at least put a box so that the paper checker will get to know where is the final answer, and if that is correct, I think every other procedure will be correct only. Now in the second year also you will have to calculate the average return. You can clearly see. So what do we do in that case? It's very simple, sir. First of all, calculate the average dividend. Multiply the dividend with the probabilities. Dividend with the probabilities. Calculate one dividend here, one dividend here. Okay. Then multiply the price with the probabilities. Calculate one price here, price with the probabilities, multiplied one price here. For the second year, please understand, for the second year, The price for X will be 220. This will be called as an investment, and Y will be 290. The year ending price of the first year will become the opening price for the second year. So when you will calculate the return only for the second year, opening prices will matter and not the purchase price. So this is going to be your investment or denominator for the returns. Now, you have calculated one dividend expected and again another dividend for the Y. You have calculated one market price here and another market price here. In the similar manner, now you can calculate the returns of each security. Then comes the topic of portfolio weights for the second year. In that case, you will have to multiply 220 with the number of share and 290 with the number of share. You will get the total market value and then you can calculate the weights in that case. Have a look. They have done it very long calculations. 1 lakh into 220, 50,000 into 290. So this is going to be the ratio, or we can say weights, right? And then see what they have done here. They took a long format for calculating the yield. That's okay if they want to go like this, but yeah, see, there is one reason behind this, because there are 3 into 3 9 different possibilities. I think 9, let me calculate. Yeah, path 1 to 9 different possibilities that arises because of this 3 different probabilities here and 3 different probabilities here. Let me just show you. See what can happen in the second year. There are 3 different probabilities of the dividend: 30, 20, 30 and 50. And for capital appreciation or market price, we can directly take capital appreciation. 20, 50 and 30. Let me just check once. 20, 50, 30, 20, 30, 50. Okay. Now understand what kind of combinations can be formed and what are exactly we are going to call it. In the second year, the dividend can be declared. The probability of the dividend that can be declared is 20%. So this dividend can be declared and the capital appreciation can be this, and this. So there are 3 possibilities: this dividend, the market price; this dividend, the market price; this dividend and the market price. So dividend is same in all the cases. Okay. Then this can also be possible that the 30% chances are there that this dividend is declared and then the market price can be this, or this. 3 plus 3, 6 answers. This dividend can also be declared, then the market price can be this and this. So there are again 3 answers. So there will be 9 different answers, 9 different possibilities of the dividend and the capital appreciation. Dividend and the capital appreciation I will take just for the X limited: 10, 15 and 20. See, the dividend can be 10, 15 and 20. Okay, and then I will go with the capital appreciation. Market price, initial beginning price is 220. So 220 minus 220, capital appreciation 0. 250 minus 220, capital appreciation 30. 280 minus 220, capital appreciation 50. So the capital appreciation can be 0, 30 and 50. Right? Now what can happen is that company may declare dividend of 10 and the capital appreciation can be 0. Dividend of 10 and the capital appreciation can be 30. Dividend of 10 and the capital appreciation can be 50. Another thing, dividend of 15, 0. 15, 30. 15, 50. then 20, 0, 20, 30, 20, 50. So there are 9 different possibilities, and you can clearly see that the probability is attached to it. What are the chances of happening of this? You should understand there is one probability with this, one probability with this, and this will be called as joint probability. When you multiply both the probabilities, the total should be 1. This probability's total is 1, this probability's total is 1. When you multiply it together, the joint probability will be reached and 1 will be the total. What does that mean? I will tell you. 20% chances are there that the dividend will be 10 rupees, and 20% chances are there that the capital appreciation will be 0. That means from 9 observation, only 4% chances are there. 0.04% chances are there that dividend will be 10 and the capital appreciation will be 0. See, this 20% probability is only for the dividend, and this 20% probability is only for the capital appreciation. I am saying 4% is the probability for 10 rupees of the dividend and capital appreciation of 0. And okay, then 20, 20, 50, 30. Now 10%, 0.20 into 0.50, 10% chances out of all these 9 are that the dividend will be 10 and the capital appreciation will be 30. Then 20, 36, this is 0.06, 20 into 30%. So 6% are the chances that the dividend will be 10 and the capital appreciation will be 50. In the same manner, you are going to do all the calculations. See, and now you will see that this is easy answer. This is the dividend. This is the capital appreciation. 0, 30, 60, 0, 30, 60, 10, 10, 10, 15, 15, 15, 20, 20, 20. Okay. Now you can see 4% probability that the total yield will be 10 rupees. 10% probability that the total yield will be 40 rupees. 10 plus 30. And we have calculated the entire probability. So we have 9 different answers, 9 different returns possible returns, 9 different returns. Okay, and then we multiply it with the joint probability, we get the expected yield, then we total it, we get the expected yield in terms of rupees, 49.50. Then we divide it by the market value in the beginning, which is 220, and then percentage of return will be 22.50. This is one way of doing the question. If you just have to calculate the percentage return, you can reduce the calculation as well. I will tell you how. But this is a proper approach because of the third part in this question. Otherwise, this is a long cut method, you can say. I will tell you another method, the shortcut method, but that is only applicable only when the third part is not asked in the question. You can clearly see there is a third part in this. Where is that? Third part in this question, which is asking us to find out the risk, and that's where we had to do all this calculation. If the third part is not there in the question, then the answer will be very easy. See, 10 into 0.2, 2 rupees. Calculate average dividend. 2 rupees, 4.5, 10. So that will be 16.5 rupees. One answer, finish. Then market price, average market price, right? Or average capital appreciation, 20 into 0.00, 50% into 30 rupees of the capital appreciation, 15, and 50 into 30 rupees, that is again 15. So 30 is the answer. So you have a situation like this for X Limited, 220, right? Capital appreciation 30, and the dividend is 16.5. Am I right? Let me just check once. 46.5 rupees. See, 46.5. It should be 46.5, right? Yeah. I just faced a problem here. It should be 60. 280 minus 220. 60 into 0.30. That will come to 18, and this will be somewhat like 33. So 33 and 16.5 will be 49.5. That's it, 49.5. You don't have to do all that thing. But this is required because of the third part that they have asked. They told us to calculate the X limited's risk. And at that time, we need all these answers. Expected yield. These expected yield will be deducted from the expected this yield. And then we will find out the deviation, then square, then multiply with the probability, joint probability, then total, and then square root. Have a look on the risk part. See, this is the probability, this is the yield, probability and yield. So what are you going to do? You are going to do yield R minus bar R, which will be 49.5. So 10 minus 49.5, 39.5. 40 minus 49.5, 9.5 negative. In the similar manner, you are going to calculate the deviation, then you are going to do the square of the deviation, then the square of the deviation will be multiplied with the probability. When you will do the total, they will give you the variance of that. You will have to do the square root, you will get the standard deviation. So the calculation, rest of the calculations are easy. That's not difficult. But understand the procedure. So I'm leaving it up to you. Nothing's new. Question number 14. Consider the following asset class return. Consider the following asset class returns for calendar year 2016. Calendar year 2016. There are three different domestic equities, international equities, and bonds. See, portfolio weight have been given to you. This is 55, 20 and 25. You can clearly see 100%. And benchmark weight is also given to you. What do you mean by benchmark? Benchmark means an index like Sensex, Nifty, like this. So benchmark weight is now 100%. Portfolio return and benchmark return. So the weights and return of the portfolio and benchmark is given to you for the domestic equities, international equities, and bond. Okay. What is the value added or active return for the managed portfolio? What they are asking you is that, first of all, calculate the benchmark return, average benchmark return. You multiply 40 with 8, 30 with 9 and 30 with 6. You will get a return. That is the benchmark return. That is the average benchmark return. Let's calculate. 3.2, 7, 1.8. Okay. So 3.2 plus 2.7 plus 1.8. Now 7.7 is the, you can say, target return. That is the return given by the index. That means no extra effort is required if you want to earn 7.7%. If you want to earn benchmark return, go into the market, find out what are the shares included in the benchmark, invest in all those shares in the same proportion, and you will get the benchmark return. But it takes a lot of efforts and it takes your time to manage a different kind of a portfolio. So that's when we call it as an active return, because we are actively involved in it throughout the year. To earn a benchmark return, you don't have to be actively involved in it all the time. The market will automatically tell you how much you are going to earn. Whatever the Sensex will earn, your return will also earn, portfolio will also earn. But if you are managing a different kind of a portfolio as compared to the benchmark, you will have to be active in that throughout the year. So you will have to take the efforts, you will have to give the time, you will have to pressurize yourself, take stress, sometimes profit, sometimes losses, everything you will have to manage for the entire year. And that's when you will be called as, it will be called as an active return. So now the question is asking you, how much is the active return? So if you calculate the return of the portfolio, you will get to know that what is the active return. Active return means a return earned by the portfolio which I managed actively, not passively, actively throughout the year by giving my own time, sweat and efforts. Calculate that. 55 into 10, that's 5.5%. This is 2% and this is going to be 1.25. So 5, 2, 7, 8, 8 point something, I think 8.75. And this was 7.71. Now please understand, when you took efforts, you earned 8.75. When you didn't want to take efforts, or we can say that without taking efforts, we could have easily earned 7.71%. So the question is asking you, what is the value added means the return for the extra efforts that you took throughout the year is the difference between these two return. That's it. 1.05% is the extra return that you have earned because you were active throughout the year. If I would have been there as an investor, I would still go with the market return in this situation, because being active in the market throughout the year and just earning 1.05 rupees of the 0.5% of the extra return doesn't make sense. It is just like staying at home, and let's say for example, you have invested in some property and you have rented it out and you are doing nothing throughout the year. Nothing throughout the year. This is called as passive income, and this is called as active income. And you are earning around 5 lakh rupees through rent and everything. And then instead of that, if you go to a job, teaching, any kind of a business, you have to be involved actively throughout the year. Am I right? And then if you are earning only 6 lakh rupees, I think it's a waste of a time. What is the value of your efforts that you took throughout the year? Only 1 lakh rupees, because 5 lakh rupees would have been earned without any efforts. That's what the question is. Understood the question? Shall I move ahead? Great. Question number 14 completed. Question number 15 is this. Okay, this is a great question, I think, and it can be left to you for homework. Why, I will tell you. The historical rates of return of the two securities over the past 10 years are given below. This should be taken as a practice. Calculate the covariance. Covariance. If you remember the formula, rest is all you can manage. Calculate correlation coefficient. So what is the formula for covariance? Understand. You don't have to remember the formula. It's just like standard deviation square. This is variance. Okay. Variance can be divided into this Ri minus bar Ri square. And because there is no probability here, what are we going to do? Divided by n. So this square can be written like this: Ri minus bar Ri into Ri minus bar Ri divided by n. Now just replace I with the first security in the first Ri minus bar Ri, and in the second bracket replace the returns deviation of the second security. That's it. Your answer is there. Covariance is easily calculated. Now what you have to do is, first you have to take the total of this divided by 10 to bring the Ri, bar Ri. And the same thing you will have to calculate here also, bar Ri. Okay, then 12 minus bar Ri, the deviation column will be there. See, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Please understand, if you remember this formula, nothing else is required now. Our returns has been taken here. What we did is we did the total of this and we calculated the average return. Now 12 minus 14.8, 8 minus 14.8, 8 minus 14.8 is minus 6.8. So this is the deviation, right? Now keep this intact, because for covariance, covariance is okay, but for correlation coefficient you need covariance in the numerator and standard deviation of both the securities in the denominator. So what are we going to do for the standard deviation? Square of the deviation, okay, then do the total of it and divide it by 10. You will get the variance. Total of it and divide by 10. I will just tell you. Yeah, this part 207 divide by 10, you will get the variance, that is 20.76, and square root it, you will get the standard deviation. Do not look at the answer, solve it by yourself with the methods that I taught you, with the formulas that you have learned. Take the formula from the formula book or chart and apply it here. That's it. Nothing else, no value addition is there apart from this. This is the second return. Take the deviation, 20 minus 21 minus 1, square, and then the product of the deviation. See, this is the product of the deviation. This 2.8 and 1 is, sorry, this 2 minus 2.8 and minus 1 is equal to 2.8. This deviation is nothing but this part. Summation of Ri minus bar Ri into Ri minus bar Ri, and then divided by n. So you will just understand the total is 84. And when you divide 84 by 10, it will be 8.4. No, it's not 84. The summation of this is not taken here. That comes to 8. If you do the total of all the figures in the last column, that comes to 8, and 8 divided by 10 will be your covariance, number of observation. If there would have been probability, you would have multiplied it with the probability. That's it, simple. So minus 8 is the answer. See, minus 8. Okay. Then you have calculated the standard deviation of both, and then the correlation coefficient is also easy. See, correlation coefficient. Now you should understand, interpret these answers. See, minus 0.8 is the risk of the two securities taken together. But if you keep both the securities separate, the answer or the risk of both the securities comes to 13.22. That means you are going from 13.22 to minus 0.8. You are reducing a lot of risk here. The answer of correlation coefficient is minus 0.060. That means almost near to zero uncorrelation. Means these two securities are representing non-correlation between these two, because the figures are very close to zero. Okay, that was question number 15. Okay, question number 16 onwards we are going to take in the next question. Why? Next lecture. Why? Because the first and the second part is again easy, but the third part you will have to understand. Find out the beta coefficient of R limited. Now the beta is calculated using two different methods, correlation analysis and regression analysis. We are going to talk about the beta concept in the next lecture. For now, 15 questions are completed. I know I have taken it very fast, but these questions are very easy. I already told you that by the time we are going to move ahead to for the next question, our speed will become slower. Like I will be slower in solving the questions by the end of the chapter, because that's where there will be a value addition. If you can solve the last questions, like last 30-40 questions of the portfolio, then I think you can remember everything. Okay, so bye bye for now.